You can take the dude out of the country. You can't take the country out of the dude.
I know what you're all thinking. Why is this guy posting about Hey Dude? Isn't this about Crocs? Well, in 2022, Crocs purchased Hey Dude from their original founder, Alessandro Rosano, for $2.5 billion. Let me repeat that. $2.5 billion due to the growth that Hey Dude had at that time. After that, their stock price tanked by about 75% as Hey Dude's wholesale revenue started to fall each year. So does this mean that Crocs is back in the doghouse, or is it still the clogs that everyone loves? Let's find out. But before anything else, to those who are new here and would like to support this type of content, please like, comment, and subscribe so I can create better content for all investors out there. Ever since I was young, Crocs has had a turbulent history as people constantly have mixed reviews of their product. At present, that conversation has not changed. Is it a lovable clog that shows one's personality? Or is it just so ugly that it's bound to fail? This constant conversation created the share of mind that Crocs has built around its brand since its formation. Fast forward to 2020, during the pandemic, they were well loved as their revenues grew higher than expected due to people being stuck at home, which led investors to also love the stock. This led to amazing stock returns as it hit an all-time high price of $183.88 November 2021 from just $8.4 in April 2020. To put that into perspective, that is a whopping 2,000% return in less than 2 years. As more cash flows were funneled into the company, this opened the possibility of acquiring Hey Dude. After the acquisition, investors suddenly shifted sentiment, and now their stock trades below $100 and is widely unloved by the investing community. Does this negative sentiment mean that their competitive advantage is now under pressure, or is their share of mind strong enough to keep the company afloat? You might be wondering what I mean by share of mind and how this differs from share of market. To easily understand this, here is a clip of the GOAT himself, Warren Buffett, talking about it.
You know, when you get into consumer products, you're really interested in finding out or thinking about what is in the mind of how many people throughout the world about a product now and what it's likely to be in their mind 5 or 10 or 20 years from now. Now, virtually every person in the globe, maybe, well, let's get it down to 75% of the people in the globe, have some notion in their mind about Coca-Cola. You know, they have, the word Coca-Cola means something to them. Everybody has something in their mind about Coca-Cola. And overwhelmingly, it's favorable. It's associated with pleasant experiences. Now, part of that is by design. I mean, it is where you are happy. It is at Disneyland, at Disney World, and it's at ballparks, and it's every place that you're likely to have a smile on your face, including the Berkshire Hathaway meeting, I might add. And that position in the mind is pretty firmly established. And it's established in close to 200 countries around the world with people. A year from now, it will be established in more minds, and it will have a slightly different overall position. And 10 years from now, the position can move just a little bit more. It's share of mind. It's not share of market. It's share of mind that counts.
Now that we are all on the same page, I will be looking into their company's core products and their top management to validate if Crocs can still be an amazing investment. As you may know, Crocs focuses on selling different variations of footwear, with clogs being the most popular. This is made using their patented Croslite material, which is known for its lightweight and odor-resistant resin. Additionally, they also sell Jibbitz, which they purchased for $20 million in 2006 from the Shelmers family. Jibbitz was originally conceptualized by Sherry Shelmers, the mom who placed silk flowers through the holes of her kids' Crocs. As this light bulb idea came to fruition, they called it Jibbitz, as an homage to Sherry's nickname, Flibbity Jibbit. This wacky name became the perfect addition to the company and completed the flywheel of their business model as they captured a niche in the market: personalization. By collaborating with popular artists, characters, and shows, They were able to create brand loyalty that pushes more people into the side of love versus hate for the company. Their clogs, matched with gibbets, became a beacon of someone's individuality and allowed self expression through their products. This resonated with customers from all over the world as they look for ways to make items in their everyday lives more original and unique. As Crocs is basically a word that is automatically associated with their clogs, people of all ages, especially kids, already have Crocs as part of their vocabulary. I would say that this has the same effect as the share of mind that Disney has with their customers. Disney creates shows and characters for kids which helps associate their brand to enjoyment and happiness at a young age. This experience could then be passed on to the next generation as new parents look for ways to entertain their kids. This is similar to how new parents would purchase Crocs for their kids and allow them to express themselves at a young age. Now, let's talk about their controversial purchase, Hey Dude. Top management noted that this acquisition is another high growth and highly profitable brand. While they are correct that the company is highly profitable based on their margins, high growth seems to be unrealistic as their wholesale revenue has been declining as mentioned in my intro. This miscalculation, paired with a $2.5 billion price tag, caused investor sentiment to decline drastically, leading to mistrust in top management's decision making. What's interesting about this is that despite the declining wholesale revenue of Hey Dude, Crocs' overall revenues continue to grow. This shows the resilience that their clogs and gibbets have in their customers' minds. Now, as top management caused this mistrust among their investors, let's dive into the two important changes that they've made since the acquisition of Hey Dude. The first and most important change is the man on my thumbnail, Terrence Riley, the marketing savant who helped Crocs grow during his tenure from 2013 to 2020. With a strong track record, he had a 4-year stint in Stanley, reinventing the 100-plus-year-old brand into the popular customer staple that we know today. Because of his skills, Crocs got him back in 2024 to oversee Hey Dude as the brand president, and he was recently promoted last May 2025 as the chief brand officer and executive vice president of both Crocs and Hey Dude. This shows the immense trust that he has built with top management and how vital his role is to Crocs' success. I would say that Terrence's skill that complements the company is creating virality. The internet enters an age where online shopping is the norm. I would say that Crocs is easily in the lead as seen from their sheer following size on social media platforms versus competitors. They were able to do this by capitalizing on current and upcoming trends. From my favorite show One Piece to singers like Post Malone, Crocs continues to expand their personalization phase to cater to more people. The next best change they made was hiring Patrick Regan as their CFO for his strong background in retail brands. For this, their CFO role was in shambles since the acquisition, with multiple changes within 2 years. There's no information on why these changes were made, that can be inferred that this is due to finding the perfect person for the position. The current CFO, Patrick Regan, seems seasoned enough in the role and industry, which quenches some of my reluctance in the company. As Crocs focuses on expanding globally, his experience is a better fit for the company as he oversaw the global expansion of Nike from 2020 to 2024 and other brands such as Ralph Lauren and Kraft. I would say that these two decisions give me confidence that top management is now on the right track in bringing Crocs back to its former glory. Now that we have an idea of the company's current state, let's dive into each brand so we can have a clear view of the company's segmented and overall business model. Starting with the Crocs brand, it can be seen that their revenues continue to grow despite slowing down due to the cyclical nature of footwear. The footwear industry is affected by current trends such as the run clubs that have been populating cities around the world. This leads people to purchase active footwear more than lounge footwear during this cycle. Despite this, Crocs' continued growth shows the resilience of their brand's power over their customer base. Their growth is mainly seen in markets outside of America as they grew 14% internationally while contracting in the US by about 5% based on their latest quarterly report. As for Hey Dude, you can see that their direct-to-consumer revenues are now growing despite wholesale revenues declining. Based on current public data since the acquisition, I would say that it is hard to know where Hey Dude's future can go. After putting both brands' metrics together, you can see that the company is still growing thanks to Crocs' brand power despite the declining wholesale segment of Hey Dude. Now that we have a better understanding of Crocs' business model, let's dive into the numbers that prove their advantages. Just like my previous videos, I will be doing a relative analysis versus publicly traded peers. For this analysis, I will be comparing Crocs' whole company versus competitors and each of their brands individually. Aside from my usual metrics, I will also be looking at adjusted price to free cash flow ratio for this comparison. As you can see, Crocs as a whole is now less efficient due to the big price tag and underperforming revenue of the Hey Dude brand. On the other hand, this really shows the power that the Crocs brand has due to how efficient they are versus peers and competitors. Their share of mind allows them to operate at this efficiency and creates a lot of free cash flow for the company. This enables them the flexibility to create viral marketing campaigns, partnerships, and hopefully better priced acquisitions in the future. Despite this efficiency, Crocs brand is trading at an adjusted price to earnings of 5.17 times, an adjusted price to free cash flow ratio of only 4.82 times, which is at least 3 times lower versus competitors. This makes the company a potential deep value investment for me. I believe that Crocs' share of mind can stay intact. As someone who was 5 years old when Crocs was invented, I can easily say that it is intact. Every person that I am around immediately associates the word Crocs with their product, and for context, I'm already 28 years old and I'm from the Philippines. This means that for 15 years since Crocs arrived in our country, their brand name has been part of my vocabulary, despite living in a small emerging market. I can only imagine how ingrained and iconic they are in bigger markets. Additionally, despite numerous generic knockoffs with way lower prices, customers purchase their products, again showing strong brand loyalty. After my DCF analysis, seeing that Crocs brand is heavily undervalued compared to competitors, I believe that this company is still a compelling purchase due to the share of mind that they have with people all over the world. With that, I have purchased Crocs multiple times throughout the year, leaving me with a cost basis of $94.04 per share. As for my steps moving forward, I will continue to monitor top management decision making and the potential turnaround of their Hey Dude brand. If they do not turn it around, I will still feel comfortable as I invested in the Crocs brand at an amazing discount. To end this analysis, I would like to quote Warren Buffett on his view on the sustainable competitive advantages of brands such as Coke and Gillette. Both Coke and Gillette have actually increased their worldwide shares of market in recent years. The might of their brands, the attributes of their products, and the strength of their distribution systems give them an enormous competitive advantage, setting up a protective moat around their economic castles. The average company, in contrast, does battle daily without any such means of protection. Thank you so much for listening to my analysis. For those who are curious about my portfolio updates and changes, please don't forget to like, comment, and subscribe. I will be doing this for future videos as well. Thank you so much.